Now, alternative investing has seen explosive, and I mean explosive interest in recent years with ETF offerings to match. But now that the Fed has tipped its hat to when it comes to rate path and everything else, the role of those alt-type investments might actually be changing a bit. Joining me now for this conversation is Paisley Nardini, the Managing Director and Portfolio Manager at Simplify, along with Todd Rosenbluth, Director of Research over at VettaFi. Thank you both for being here with us in studio today. We appreciate it.
Thanks for having us.
All right, so let's talk a little bit about the alt side of things. And Paisley, I will start with you, because for those people who did watch our CNBC air for the halftime report, we kind of teased a little bit of the content we're going to have on this show today, which is the growing role of alternatives and then how they manifest themselves in exchange-traded funds. Simplify specializes in these types of investments. Why are alternatives getting so much more attention these days?
Great question. Thanks for having us today. I would say one of the biggest drivers of the rise of alternatives, both from an AUM perspective and an adoption perspective in portfolios, is really driven by stocks and bonds and how they behave together. We've relied on this historical correlation between stocks and bonds, which has been negative for really the last 10, 15 years. And with the rise of interest rates in 2022, stock-bond correlations became positive. What does that mean for a portfolio? It means that bonds are no longer providing that ballast. And I think bonds have been a big headwind for a lot of multi-asset portfolios the last few years, which now has investors looking for unique sources of risk and return in the portfolio. And one thing I've mentioned on this show in the past is thinking about what historically has been a two-legged stool of stocks bonds is now becoming a three-legged stool. How can investors look beyond their bond portfolio to find other ways to provide ballast in equity market drawdowns, other ways to find sources of income? That's also a growing part of the alternative market is equity income solutions. And so all of those tailwinds are really leading investors and allocators to start thinking about this third leg of the stool, an additional way to build out a more resilient portfolio, but a lot of that driven by just how stocks and bonds have behaved together.
Since the great financial crisis, by the way,
Yes.
It maybe is no coincidence that since the active intervention from central banks, putting a bid underneath the market for bonds, lowering interest rates and boosting equity valuations,
Yep.
that you can kind of see that positive correlation moving, manifesting itself in bonds and stocks. We've talked a lot, Todd, about I wouldn't say death of, that's hyperbolic, but we've talked about the 60-40 portfolio, right? Stocks and bonds, how you kind of move that on a scale based upon age. But a lot of people have said that 60-40 model is kind of evolving away or going away. I wouldn't say going extinct, but to Paisley's point, there are now multiple more options that you can put besides stocks and bonds. What exactly are alternatives in terms of your view? What is the role of alternatives in trying to kind of provide a little bit more of that diversified approach to investing?
Well, in the ETF space, it's a pretty broad category. So you mentioned it's been evolving. It was traditionally gold was the way to get exposure, and we've seen record highs for gold and strong demand for ETFs like GLD and GLDM. But we've also seen a new wave of products that have come to market that offer alternatives. Calamos has a auto-callable income ETF, CAIE, that's been in the market a couple of months and already has $200 million. Unlimited has launched some funds in the hedge fund-like space that's in that space. And Bitcoin is, of course, for many people, the alternative that they've been using to get exposure to ETFs, whether that's spot Bitcoin or that's offering something else. But what we find is that advisors are looking for something beyond, as Paisley said, stocks and bonds. They want something else to be a diversifier, whether it offers income or just has higher return potential. And the ETF space has been a great place to get exposure.
Paisley, Todd brings up an interesting point, that it's advisors who are looking for these different types of instruments, different avenues to go down. Advisors are one part of the equation, but the people that advisors service are also a big part of that equation as well, and might be a driver, base-wise, for much of the interest from retail investment advisors, and whatnot. Do you feel as though it is not just the advisors themselves, but perhaps even the clients they serve that are driving a lot of the narrative around why people want alternative investments?
Yeah, I think you're right. And it's actually been pretty interesting in the most recent kind of rally in equities. It's actually been driven more by the retail investor than the institutional investor, which I think has caught a lot of people off guard. It's not typically what we've seen. But to your question is thinking about that need at the retail level, the end client, there's always a need for income in portfolios. And as back to your earlier comment or question, and thinking about as we're starting to cut rates, as yields are going to come down, there's going to be a greater need for alternative sources of income for many of these retail portfolios. You mentioned some of the strategies that have come to market. Simplify also has strategies within the equity income space. And so if you're thinking about core bonds might be delivering about 5-6% yields. If you're thinking about equity income solutions, those can be delivering double-digit yields through selling options, whether they have barriers or whether they're put options, to deliver income in 10, 12, 15% type levels. I think that starts to become really attractive, especially for retirees in the retail space that are looking for ways to supplement their lifestyle, especially once they're no longer working.
All right, so the income side of things is interesting, especially when it comes to using options or derivative type strategies to kind of get those. We know that there are many targeted outcome or buffer type products that are coming to market or have come to market these days. If I could follow up Paisley on that, we're also dealing in a macro environment right now where, because of the nature of interest rates and the equity markets at or near all-time highs, volatility premiums have collapsed in many ways, and they are well below their historical norms. That also means that if you're looking to sell derivatives or options to generate income, you're not generating as much as has been expected in the past. How exactly does an asset manager kind of navigate those types of waters where volatility is cheap, so to speak, on a relative basis, but you're trying to use it to generate income?
One thing we actually saw coming out of the tariff tantrum earlier this year was heightened levels of volatility premiums that we were able to capture. So thinking about active management, and Simplify is an active manager, looking at the opportunity set, thinking about the risk reward profile, and having the manager have the ability to have discretion. So when there are opportune times like we saw in the May, June, July, and even August timeframe where those premiums were elevated, strategies that historically have delivered or expected to deliver maybe 10% or closer to 13% for the last few months, an active manager can start to thinking about smoothing out that income potential for clients. So kind of harvesting some of that greater yield today for when yields start to drift lower over the next 6 months. But to your point, I do think we're starting to look at kind of a reduction of yields. And so again, the active management component of that allows us to kind of manage around that and set expectations.
Todd, the idea that the macro still at least plays a huge part in the narrative around how investment managers are kind of managing around client funds. It also comes to a point where you're looking at the types of income generating strategies that are out there. It is a big part of some of that alternative story. But you guys also mentioned asset classes that are not typically associated with spinning off income. You mentioned gold, not a dividend type, investing, construct. Bitcoin, not a true kind of income producing product. So when it comes to alternatives, Todd, how do you kind of look at, from an investor standpoint, about the types of places you should be looking inside and outside of income requirements?
So I think it matters what your goal is. If your goal is to provide a hedge against volatility in the equity and the bond market, then gold can provide that as a safe haven. If you're looking for reward opportunities, Bitcoin has been very rewarding, and using ETFs to get exposure to that and the growing number of cryptocurrency strategies that are there. If you're looking for income and you're looking for diversified ways to get income, then these covered call strategies that have become increasingly popular are a good way to be able to do that. Private credit is a good way to be able to do that through the ETF wrapper. There's lots of other ways to get income outside of your traditional equity through dividends or bonds.
And I might actually add to that, Simplify has addressed that concern that you mentioned, or a pitfall of some of these alternative asset classes which don't have income potential in them. We have a gold strategy, Wide Gold, which has a levered gold plus an income overlay. So for clients that are maybe funding this from a bond portfolio, they don't have to sacrifice on that income potential. We also have a similar strategy within crypto, a Bitcoin ETF, Maxi is the ticker, which also has our active income overlay embedded within that. So that's a way to deliver the alternative diversification, but then also address that common objective that many clients have, which is income.
So it's become almost like the next evolution of structured products in that way, right? So you're trying to find ways to take an underlying and use trade strategies around the underlying to get a targeted outcome the way that you want to. Paisley, if I could just follow up on that point. If you are looking at some of these alternative type strategies, where do you actually see as an investment manager the most kind of interest coming from? Is it from places that are straight income equity or income fixed income? Is it around option strategies for underlying gold or Bitcoin type strategies? What exactly is driving a lot of the interest in alternatives right now?
Very simply stated, I think when you see a high level of income kicking off of a strategy, that's what captures investors' attention, especially at the retail level. A lot of retail investors might not understand the nuances or intricacies of options or derivative components, but if they're seeing a 10%, a 12%, a 15% distribution rate, that's something that resonates with them. So as it relates to what has really captured attention and flows, I think income strategies, whether they be equity income or more traditional sources of income, are absolutely at the top of that list. And I would say in kind of a little bit lower down, but definitely gaining attraction from more of the sophisticated high net worth RIA type clients, is true diversifiers, such as trend following. Strategy that has the ability to go long, short. Many of the exposures are not tied to economic risks, so they provide that true diversification, low correlation to stocks and bonds, and really help to smooth overall portfolio volatility.
She's, I think, referring to commodity trading advisor or CTA, momentum following strategies. They're basically kind of computer model driven strategies that kind of track movements in prices to try to follow trends that are happening right now. If that's the case, Todd, if those types of strategies are the ones that are getting a lot more attention these days, what exactly does that say about where investors have evolved towards over the course of the last 10 years? It's no longer just about, hey, I kind of like these stocks or this portfolio. These are the types of things I'm looking for: earnings growth, revenue growth. Many times this is a straight up kind of formulaic approach to just following momentum trends.
So a couple of things pop into my mind. One is that even though we're at record highs for the equity market, even though the Fed cut once and is likely to cut multiple times, many investors are still nervous. They're looking to diversify their portfolio. We've heard from them at Verify. Obviously, you've seen the flows there. Also, it just, to me, the ETF wrapper has become so comfortable for advisors, for investors to put into their portfolio that they're now looking to the ETF space to get exposure for that diversification, whether that's through Matters Futures approach, whether that's through commodities, whether that's through Bitcoin. I came back to it again, but we've seen record demand a second year for Bitcoin strategies in the ETF wrapper because people still are gaining comfort in that space.
This is also very much a demographic story in many ways, right? This idea that there is demand for certain types of these income-oriented or targeted outcome-type products, because as people are getting older or more progressive in their life cycle, they're looking for ways to become slightly more conservative, but not lose the entire upside that some of these investments can give while still collecting a paycheck on a monthly, quarterly, or yearly basis. To that point, Todd, and I'll start with you on this one here, just how much is that demographic tailwind going to be something that can be captured? Or is this just a kind of product cycle that you think maybe has a finite runway? Or is this one where you think that, this is going to be something that's going to have decades in terms of runway?
So I think the finding alternative ways to get income is going to be a trend that's going to persist for the foreseeable future. We've seen it came on a few years ago. JP Morgan was one of the initial products that had success, JEPI or JEPI, and it's now several years later and we continue to see traction, but it's evolved. We've seen exposure to other products. We've seen it for individual stocks to get income generation. That's probably a little bit more risk-taking than the older generation of folks, but I think that income is still important for many people, certainly as they get older, and the ETF wrapper is something they've become comfortable with. I think this is a transitional change.